Hi everyone. Welcome to this Blackstone Gold webinar, Commodities in 2022, where we will be discussing some of the trends, issues, and red flags facing the commodities trade sector. Over the last kind of few weeks and months, much of the news coverage around commodities has revolved around price changes, in most cases dramatic increases in price, and we'll be taking a look at for instance, LNG trading in that context. We'll also take a look at some other commodities, so oil, where most benchmarks seem to be marching towards $100 a barrel, coal, which is proving lucrative, but is facing the prospect of divestment on environmental grounds, as well as turbulence around supply and demand related to Chinese imports. Agri, so for example, we're seeing steep price rises in palm oil, with labour shortages in Malaysia and efforts to stabilise the market in Indonesia, and we've seen the same kind of thing in metals trading, so limited supply driving up prices, for instance, in aluminium, copper, lithium. But we won't just focus on price pressures. We'll look at the conversation around renewables. So despite the kind of political momentum towards green energy, the larger coal and oil traders are reporting some pretty incredible results, and we'll look at some of the practical issues that our panel of experts are seeing in the market at the moment, including quite a topical one as we speak, the tensions between Russia and Ukraine, and by extension likely with many of Russia's trading partners, for instance those reliant on gas exports. So if there's time, we'll look at some related issues around maybe commodity finance or technology. But if there is anything you would like our speakers to address, please feel free to use the Q&A function. We'll get to as many of your questions as we can. To introduce everyone, I'm John Basquill. I'm a senior reporter at Global Trade Review. I'm part of GTR's editorial team in London. And it's a great privilege to moderate this conversation today. Joining me, I'm delighted to introduce Baldev Binder, who's Managing Director at Blackstone Gold, Ignatius Huang, Partner at McDermott, Will and Emery, and Merrick White, also Partner at McDermott, Will and Emery. So Baldev, to kick us off, how would you characterize the commodity price situation today? What are some of the things you're seeing?
Thanks, John. Well, I think it's all gone a bit mad, to be honest. Prices have escalated, they've spiked. And when you look back and you try to understand the fundamentals of what's changed, the question is not very much. So when you're looking at commodities, when you're looking at pricing, there's either the supply side or the demand side that's being driven. For a majority of commodities, the demand side has kind of stayed the same, putting aside green metals, for example. But it's the supply side that we're really seeing huge changes, and I think that's driving the prices to go up or down, as the case might be. When it comes to supply, you have things that have an impact on the short term and also on the long term. Short term, for example, let's just say there's a hurricane, there's a storm affecting crops. You can't get enough crops, and so there's an impact on the supply, increases the price in that period of time. On the long-term horizon, you have things that certain commodities are affected in the long term. I'll give you an example. Copper. There are X number of copper mines in the world. Most of them are in jurisdictions that you and your neighbor probably wouldn't want to go to. They're very difficult to get production up and running. So there's only limited copper floating around the world. And if demand increases because there's a push for electric batteries or vehicles, then the supply of copper gets tightened, gets constrained, price goes up that way. The only bucket that I see a change in demand, to be honest, is green metals. So as you mentioned, there's a political move and a right political move to adopt green energy. So that means you want to have more electric vehicles, more batteries, nickel, lithium, copper, all of it goes up. Aluminum, all of the demand of that goes up. So there's a real push for green metals, and that bucket, the demand goes up. The other category I would sort of say is it's a unique situation of micro events, and this is something that is what we're seeing today. For example, the crisis in Ukraine. that's going to push up prices because, in short, Russia produces a lot of commodities, and I think that's going to impact the ability of Russia to buy and sell commodities if it gets sanctioned. You have the situation in Indonesia, for example. There was an energy crisis, or there still is an energy crisis in Indonesia. They have tried to divert some energy coal to domestic users instead of for export. You have people like China reducing aluminum production because it's so high energy consumption centric, and they're trying to reduce it as much as they can. So you have all of these different factors applying at the same time. And it produces this sense of scarcity. And I want to impress upon the audience that scarcity, it's a hard one to figure out. Some of it's real, some of it's apparent. When you look at crops, for example, yes, there are not enough crops being planted, but is there more inventory being kept in the processes, in the warehouses, for example? So is there really scarcity? This is a question that I think it's very hard to actually pinpoint and sort of look at in detail. I'll let Ignatius talk about the renewable sector, Marek particularly on the LNG sector. I just want to make one passing comment on the energy crisis. And we are in the situation where there's an energy crisis. It's largely because we're trying to move away from fossil fuels, rightfully so. But that move has been a bit too drastic, in my honest view. It's been too quick, and that left a lot of sophisticated producers have left the market, and you don't have enough oil or coal to go around. So now there's a huge pressure on energy fuels, and gas is the go-to predominant mix, and that means LNG and gas, and that's been struggling to keep up with worldwide demand. So the prices of gas have gone up, and this, I think, calls into question the limitations of renewables, the pressures of LNG, which I think I would love to hear Marek speak about, and the reality, the sobering reality that we can't really do without coal and oil for the time being. We should phase it down, but phasing it out immediately would just create more of a mess. Marek, I'm happy to hear your thoughts on this, about LNG in particular, when all competing demands were sourcing into gas.
Okay. Looking at both the LNG, and it's also worth touching more briefly on oil as well. Supply has fallen on the oil side. After the 2014 oil price crash, about 10 million barrels of conventional oil production has been retired because it was no longer economic to produce it at around $40 per barrel. This conventional oil has not necessarily been replaced by shale, OPEC production, Russian production. And now we've got demand rising. Forecast for 22 is 100 million barrels per day, which is about 3.3 million barrels per day higher than last year. And so we've actually got more demand and supply struggling to keep up. And as you've seen, the price has gone through the roof. And then you put on top of that a Russian invasion of Ukraine, which seems to be happening this morning as we're talking. I mean, oil, I expect, will probably go through $100 per barrel for Brent while we're online. When I looked, it had gone up to 99 just before we started. So there is a long-term fundamental problem that the oil demand is outpacing oil supply. The conversion to green fuels isn't happening anywhere near fast enough to bring down that demand. But there's been a lack of investment on the supply side. And when we talk about a lack of investment, we're talking about lack of investment going back 7 or 8 years now. There's been very limited exploration in the upstream business because that's one of the first things you cut when money's tight. And so there aren't a lot of new discoveries out there waiting to be brought online. And those discoveries that are out there, many of them are struggling to raise finance. So there is tremendous opportunity out there for the people who want to finance these sorts of investments to make cracking returns. And one of the, for me, I think one of the very positives is the trading environment is stepping into that market. Recently, we worked with Trafigura on a $200 million funding for Sirius Petroleum's Nigerian development. And earlier this year, we worked for Mercuria on their funding of Batavia Oil's acquisition of Perenco's assets in Vietnam. And so there is money out there, and we're seeing it move from the traditional banks, who are now constrained by green PR and green initiatives, to some of the more interesting funders. And I hope a lot of you are on this call, but this is a good thing. Moving over to the LNG side, well, LNG's always wanted to have, and the gas markets always wanted to have, gas on gas pricing. They wanted to break away from the linkage to the oil price, which traditionally was how gas was priced in Europe and out here in Asia. And they got what they wanted. They now have JKM, they now have TTF in Europe, they have National Balancing Point in the UK, and you have gas on gas competition. What I don't think was appreciated is that there is very little gas storage and even less LNG storage around the world, so that when demand even slightly exceeds supply, which we're seeing this winter in particular, there's a strong demand ahead of supply, causes massive price spikes. We're up to what, $30–40 per million BTU in Asia for delivery this month, where in 2020 we're talking $2 or $3. I mean, that's a huge increase in cost. And a lot of it comes down to the inelasticity in the LNG and gas markets because of the lack of supply. So my view is there's a great investment opportunity, but it is an expensive one, it being gas or LNG, to build out more LNG storage. And we're seeing Singapore LNG are looking at building further tanks because they've identified this as a long-term problem for the region. And LNG is not like oil. I mean, sitting here in Singapore, you can look out the window and you can see tankers parked all the way to Batam, going down the straits. And those tankers store a huge volume of oil. Most countries have their own strategic petroleum reserve, and there is none of that really for LNG. And so Singapore LNG's attempts is to try and build out that sort of security here in Asia. And that will help slowly over time to balance the LNG prices. But at the moment, there is not a lot of new supply coming onto the market this year. And so next winter, we'll probably see a very similar sort of price profile as we're seeing now, particularly if this Russian and Ukrainian conflict escalates. And I mean, Europe's storage is empty, and if it doesn't refill this summer, they will be buying LNG in vast quantities to try and refill it, and the price may stay up this summer.
Can I ask you whether you've seen a change in the type of contracting structure? So LNG, typically it's done on long-term contracts, and then if you've asked anyone in the market last year, the year before, everyone was running off to spot contracts because the prices were cheaper there. And have they now gone back to long-term contracts because they need the security of knowing that there's going to be a long-term provision of LNG?
You've touched on one of the peculiar quirks of human nature. For the last 4 or 5 years, I've been trying to persuade buyers to buy long-term. Buy long-term when it's cheap, not when it's expensive. And they all say, oh, no, the spot price is much lower than term prices. We wouldn't want it. And now you're looking at a position where people are starting to look more at long-term. And that's a good thing, because upstream LNG plants can't get developed unless there are long-term buyers. The spot market only accounts for about 30–35% of global LNG trade. And you cannot finance an upstream LNG project based on spot sales. It's unlike oil. Oil, you find it, you do your engineering, then you go out and you finance it and you sell the oil when it's ready. You don't have to worry about selling it before you raise finance. LNG, it's the other way around. Unless you've sold your LNG, you can't get it financed. And the lack of long-term buyers has hampered many developments around the world. And so hopefully now people coming back on long-term with term prices are going up. I mean, they got down to as low as 10.5% Brent, I think Qatar did. But now they're edging up, and I hear, they're back in the 12s in the market, if not higher. But they're still historically a long way below sort of the 1485s, 15s that we saw at the very peak of the term market. So there's still good prices in the long term. And also people are starting to look at, do we price our long term based on JKM? Though I imagine this winter's caused a huge amount of doubt on that one at the moment, because yes, it's a gas on gas price, but if you're a buyer, you're saying, well, I might as well just take the spot risk at that point. And so I think we'll start to see a move back to people saying, yes, some of this oil priced linked pricing is actually a good thing.
That's the irony of LNG. At any point of time of its evolution, there are some people that saying oil and LNG has got a poor correlation. That's the cause of the problem, really. And yet sometimes when it suits themselves, they would rather stick with the oil price, and when it doesn't, they would move away and saying there has to be a gas index. The question I have really is about gas being the predominant fuel mix. So everyone wants to move away from the hardcore fossil fuels, from oil and from coal, because it's naturally high carbon emitting substances. And so they look at gas and they look at renewables in particular. And before we go to Ignatius, I thought maybe we could hear from you on the challenges of having gas as the predominant mix.
Well, the current LNG prices have made coal look very attractive again, and coal prices have been rising as well. There are a lot of social issues involved. I mean, I grew up in the UK in the 80s when there was the miners' strikes because the coal in the UK was just not economic to produce. But the social issues were what were driving most of the problems. A few years ago, whilst struggling to breathe in Beijing, I had a conversation with the state-owned gas companies saying, why don't you just burn gas? There's plenty of gas available, you could do it. And he said, Merrick, 80 million people work in the coal industry in China. We can't turn off the coal industry. It's 80 million jobs. And you suddenly realize there is a huge inertia, both through the social infrastructure involved and also through the investment in these coal plants. And people don't want to write that off, and they look at it and go, it's economic at the moment. And yes, in the world, we're seeing a tremendous amount of push to go green. But of all the world's green initiatives, only 4% of the countries of the world have actually signed up to anything legally binding. The UK being one of them, I think it was Denmark, and there's about 3 or 4 others. So a lot of countries are saying, yes, the environment's very, very important, but so's my economy. And I will not kill my economy for the sake of the environment. And so there is still a future for coal. At least with the existing plants, I don't see them being turned off until they sort of expire through their own life longevity. So I think there's still a hope for coal, but one of the problems for coal is the lack of ability to finance any coal development, and we're starting to see that very much in the oil side of the business, and it's creeping into gas and LNG. It's getting increasingly difficult to finance new developments and acquisitions, which again leads to the lack of supply, which drives up prices. So for those who've got money and those who are wishing to invest in sort of counter-cyclical process, I think that the returns will be superb.
There's a TED. Sorry, go on.
I was just letting Ignatius come in on the renewable side, which is the future for the energy industry.
Well, that's what most people and politicians hope and think. I think that's it's certainly not the silver bullet. I think it's obviously in my view, the world has sort of gone mad the last couple of years with climate change, particularly ESG, obligations. And to some extent also the COVID pandemic and the high energy prices that occurred in the last 12 months or so, I think obviously help the argument that it's green is the only way out of this. But totally agree with you that green can't really replace the sort of the baseload baseload fuels like gas, oil, and coal, particularly in countries where, as you say, China, Indonesia, where there's lots of coal, lots of people, jobs depend on those industries, and I don't think any government would want to sacrifice that just for the sake of its COP26 obligations and the Paris Treaty obligations. It all sounds nice and good. Just to give you some context, so In ASEAN alone, that comprises, I think, about 10 countries. 80% of the energy is still powered by oil, gas, and coal. 80%. Currently, only 15% renewables come into play. There's obviously some targets. The ASEAN group has sort of proclaimed they'll try to hit 23% by 2025. That's not going to happen. Best case, maybe 17%. The ADB has projected that to get there, that needs to have close to $300 billion of investment just to get there. Just think about it. Where's the money coming from? I mean, it can't totally come from ADB alone. So it's good, and I'll talk about that in a short while. So in terms of opportunities, obviously, yes, everyone is pretty rah-rah, and the proclamations in terms of achieving certain targets by various countries would obviously encourage or maybe over-encourage investments and everyone else flocking into this sort of renewables craze. So for example, China, the grand proclamation, 80% renewables by 2060. 40% by 2030. Wow, that's, and that's really on the back of hydro, solar, and wind, essentially. Currently, China is at 28%. So, I guess if anyone has, has a chance of success, that would be China. Look at India. India proclaims 50% renewables by 2030. That will be another 500 gigawatts. Massive, massive. Vietnam, which is probably the most active and most successful, jurisdiction in the last couple of years, in sort of increasing, accelerating its renewables mix or percentage into the overall energy, framework. They're looking at adding another roughly 20 gigawatts of wind and solar in the next 7-8 years. Massive investments have gone into Vietnam, and you can see it's continuing to do so. But it's going to be interesting because I think with the change of approach from the feed-in tariffs to the proposed, and I think it will happen in a couple of years, sort of the auction type or competitive bidding type tenders. You're going to see, and you've already seen, a sort of a decrease in tariffs and margins and returns. I'll just pick one more country, say Indonesia. Yes, looking at 30% renewables by 2030. So looking at all these headline numbers, if you are an investor with lots of money, you would say, why don't I just go into this space? So the proclamations obviously encourage the investments and to some extent the financing as well. And when you talk about financing, I think there is a general and increasing recognition that most of this, whether it's hydros, solar, wind, do attract now more local financing, as well as commercial. You see in certain projects, whether it's a question of it being rather challenged or perhaps of a large scale, you don't typically need the multilaterals to come in these days. So you see a lot of local lending. You do see a fair bit of private equity guys coming in now, which is very interesting. Infra funds as well. KKR has, I think, set up a fund about a year ago. I think it's a $300 billion fund investing in green energy in Asia. And then you start seeing the proliferation slowly in certain jurisdictions of green financing, green bonds, not uniformly across the entire Asia region, but in more I suppose more stable and more reliable jurisdictions. So certainly the money is flowing in. We do see, for the smaller projects as well, family offices, high net worth individuals also coming in, which is interesting as well. I'll probably just quickly touch on the challenges. So it all seems good. It all seems like you should go all in, into renewables, but perhaps just hang on a bit. So there are still a couple of challenges that you need to be aware of, and the risks as well. So obviously one of the things you should take note is, depending on whether it's Vietnam, India, China, Indonesia, what's the procurement model, whether it's a fit-in tariff, which used to be, typically that's been adopted to sort of kickstart all these renewable programs, whether solar or wind, as demand, or rather investor demand, comes in. You see two things. You see a significant decrease in the pricing, which is good for the country, but bad for the investors, of course. And if I recall, about 10 years ago, the solar fit-in tariffs for India was so low that one wonders how anyone could make a buck, and that led to a bit of a number of bankruptcies and restructuring in terms of the of sponsors and so forth. So the more advanced countries, or countries that are ahead in their renewable programs like China, India, have now reverted to auctions or competitive bidding. Obviously, PPAs are still important. The off-taker credit is also very, very key for financing. For example, the Vietnam PPAs are not exactly consistent with internationally accepted PPAs. International banks still struggle to fund, the solar and wind projects, but the local banks have stepped up. So far, it's it's still humming along quite nicely. There's been proposed moves and proposed regulations to fix some of these issues. Obviously, the legal and regulatory framework very important as well for each jurisdiction, and land procurement, particularly for solar, is interesting, and to some extent for hydros as well. The environmental situation as well, the environmentalists, in some of these countries, you've got to get through, the EIAs and all that, and that could be very challenging. But what's very interesting, that is, I think, has an immediate impact on investments in renewables, particularly, I would say in solar, is for the last probably 7 or 8 years, solar prices or solar panel prices have been, dropping like crazy, probably as low as or as much as 70%. Then came COVID, and supply chain disruptions occurred, and obviously this mad rush into solar in some jurisdictions. Panel prices plus labor obviously have gone up by 30% now. So that's going to kill the economics of those sponsors who bid for projects probably about a year, 2 years ago. I'm not sure where the margins will be, where the project returns will be. So I think that's going to be very, very challenging as well. So I'll probably stop there. I think I've given a bit of context. I would say, yes, if you've got a spare buck, I think renewables is still the way. But we've come to a certain stage of phase in the renewable space, particularly in some of the countries like China, India, Vietnam, that you probably need to do your maths, tread a bit more carefully, because the margins are being squeezed right now. But I think the grand proclamations of all the various countries or signatories to whatever treaties there are out there, I think it's bottom line is, I don't think renewables can, so maybe a bit of hydro, maybe a bit of wind, but for solar, they will be able to replace the reliable fossil fuels power generators for a long time. So you have either you put money into coal, as Merrick say, or gas, and maybe put some money into renewables to double hedge. Thank you.
Well, Ignatius, I wondered what your thoughts were on. So Merrick made the point that the kind of supply crunch in oil has been coming for a good few years, and is partly being driven by a lack of investment in exploration. Then obviously you mentioned the International Energy Agency, that they've said in order to reach net zero by 2050, there should be no new investment in fossil fuels projects. How can you kind of marry up those competing interests where exploration is discouraged on environmental grounds, but the lack of exploration is causing some issues around price?
Well, I think both actually exacerbate the situation, in many ways. So the underinvestment or lack of investment in oil and gas sector, particularly upstream, obviously is an issue that needs to be fixed. And I think it's the market will work itself out when people sort of wake up to the situation. Obviously, the challenge now, as compared to 10 years ago or 7-8 years ago, is where are you going to get the financing for the sort of the gas coal projects? You probably won't get it from the conventional banks. They've all signed up, as well, and even the Chinese banks have said they'll stop building fossil fuel plants outside China or financing. So I think but there is a lot of money out there, and as I say, and Merrick has pointed out, that there will be new money or new sources of money coming in, and I think where that would be the private equity guys and the infra funds that may come in, or even some ultra rich family offices where they do see the opportunity, and obviously the traders, because they obviously need to keep that flow going. On the renewable side, I think there's a lot of encouragement. I mean, that's the obviously flavor of the month. Everyone's rushing there, but I think at some point the realization will come that it's the margins are not there, and again that whole rush will come to a halt as people take stock and see where would be the best use of their money, and then it could flow back into the fossil fuel. So at the end, I think there is obviously smart money around, and the smart money will find its way to where it makes the most money, really.
Excellent, thanks. I think that leads quite nicely onto this point around alternative funders, alternative lending. Baldev, where are you seeing kind of flow of investment, and is it different when you look at kind of traditional financiers compared to maybe private equity investors or alternative lenders?
I think alternative lenders are going into commodities in a big way. They have been for a few years already, so I don't think it's necessarily the energy crisis. I think what you will see, as Merrick mentioned, many people are moving out of fossil fuels, and there's a big gap over there. If you are a betting man, and a betting man without too much constraints on your morality, then maybe a fossil fuels are the way to go in terms of putting your money back into mines and the like. The issue, the fundamental issue, the morality issue about it is that you want to have a situation where for fossil fuels are being mined by sophisticated producers. You don't want to leave it. If everyone just leaves, then the next guy is going to pick it up. He's not going to be particularly effective or efficient in the way he's doing it, and he's actually going to add to the carbon problem more than it needs to be. To answer your question on alternate lenders, I think they come in different shapes and forms. Funds, private equity funds, trade finance funds. Now every fintech claims to have some element of trade finance / commodity financing aspects to it. We've seen the dangers of how fintechs, that they should be. They have a great business model. They do a great service to society, but they also need to be handled with a bit of caution in terms of what they are able to see and what they aren't. on that. I also wanted to mention one brief comment on energy before we change the topic, and that was there's a lot of talk on energy and oil and gas and how that little world by itself is important. But most people don't realize that it actually streams down to many other different aspects of commodities. And I'll give you an example. Fertilizer actually is something that's produced one of the best results since the last 10 years. Fertilizer is enjoying its best decade. Why is it enjoying its best decade? It's because fertilizer is a high energy consuming substance. It needs high energy, high amounts of energy for production of nitrogen or phosphate and potash that goes into fertilizers. Because it needs high amounts of energy and the world is now having an energy crisis, that means the price of fertilizer now, the supply of fertilizer goes down, price goes up. And that means that crops that all need fertilizer, every form of agri that needs fertilizer, now goes up. And all of a sudden, then there's food scarcity, and then there's food inflation. The cost of your end produce becomes more expensive. I know that was a bit of a side track from the main question, but I think when we're talking to the audience in particular, everyone's quite zoomed in on energy, but the sprawling effects of energy. Aluminum is another example. You need a lot of energy to make bauxite into aluminite and then onto aluminum. Without that energy, you're not going to have aluminum, and that's why now there are low supplies of aluminum. And it doesn't help that Russia, one of the biggest producers of aluminum, is now going to be in a fairly hostile sort of situation.
Yeah, that's an excellent segue into that point. We should probably delve into that a little bit. I just want to say before we do that, if you can, I think can everyone access the meeting chat if you want to submit any questions? Because in about 5-10 minutes time we'll go to those. Or alternatively, I think you can raise hand and we could go to you that way. But yeah, so Russia. Maybe Merrick, I could come to you on this. What do you think could be the likely consequences of what we're seeing today?
I've been pondering this over the last few months, and there's an enormous reticence amongst the Western politicians to bring in sanctions that affect the oil and the gas. They could cut off all gas supplies from Russia to Europe. They could probably shut down a huge amount of the oil production if the sanctions worked well enough. The problem being that would then put the price of oil and the price of LNG even further up, which would cause massive harm to everybody's economies. Energy prices, as high as they are causing problems already. We're seeing inflation, retail price inflation in the UK of 7.5%. So it's starting to kick in. So I think that they will ensure that oil and gas in particular, and probably the other vital commodities, keep flowing. And they will have to try and structure sanctions that work around that, which I think they're finding increasingly difficult. So it's going to be a very tense few months. And, personally hope that it doesn't end up in armed conflict, but it does look as though it's heading that way. But the West, through the way it's structured its economies, are now reliant on the global markets. And when you're reliant on a global market, you cannot cut it off without doing substantial harm to yourself. And I think Russia are probably relying on that fact. So I do think we will be seeing a certain amount of premium because of the uncertainty over that. But I think the oil and the gas will keep flowing. And just to bring back to Baldev's point, we keep hearing the word transition, and that implies that there's some sort of orderly change from a hydrocarbon-based global economy to a renewably based global economy. And it's a very misleading phrase. What we're seeing in some ways is chaos. We have some markets that are running on government proclamation, and we have other markets leaving it to market forces, and neither one of which is working. We have people like the IEA saying, stop all oil production now, and we're starting to live with the consequences of that. But that brings extreme energy poverty to most of the developing world. If you are a rich Western economy, you can probably afford to stomach these high prices, though they do harm your economy. But the social impact of the energy poverty shouldn't be overlooked. And I think what we will see over the next few years is hopefully a more rational discussion about what would an ordered transition look like? How do we actually get to this without destroying people's economies through very high energy prices? Because it's going to be very hard to bring on a new LNG project. It's going to be very hard to bring on a lot of new oil projects. And Rystad estimated that to reach the global target of only a 1.5 degree centigrade temperature rise, that you still need 1,000 new oil fields of at least 100 million barrels recoverable each to be brought on by 2030. That's still quite a lot of exploration because they're not out there. Morgan Stanley said to meet the LNG demand by 2030, we need 73 million tonnes per annum of new projects every year. Well, the best year for new projects was 2019 when we did, I think it was 64 million tonnes per annum, and that's $65 billion worth of investment. In 2020, I think there were no FIDs or only one, and there were no US FIDs in 2021. So we're a long way behind the long-term demand. And that was a balanced analysis saying, if we slowly replace coal with LNG, and then LNG in time gets replaced with renewables, and we're not meeting those targets. What we're seeing is a lack of that, which then people will carry on relying on the coal-fired ones that are existing, which doesn't help the green argument and the low carbon argument. So I do hope that over the next few years, we start to see a more sophisticated and detailed analysis. I mean, COP26, the first 2 days was every politician in the world berating everybody and coming up with the biggest doom-monger story they could. All very well and good, nice to see you're behind it, but what are the practical things that you can do to manage what is a global issue going forward? There was sadly a big shortage of that coming out of COP26.
That's an excellent point, and we've had a question come in which I think leads on from that really nicely, which I think Ignatius is probably well placed to answer. So the question is, will the energy supply constraints that we're seeing, will those make governments rethink their energy strategy or targets?
I'm sure, the quick answer is I'm sure it will. Probably just sort of a case in point, Singapore. I think at COP26, we had said we'll try to halve by 2050, we try to halve our 2030 peak emissions. I think where we are now, obviously, I think Singapore has always sort of had these proclamations, but I think it's also pretty realistic in that it has to look after its own, industries as well and the economy. So it's very carefully calibrated. On the sort of the visible actions taken, you see the carbon tax coming in. I think it's just gone up a bit now. The sudden, I would say, shift to the and it's a new strategy, obviously, probably accelerated by this sort of commitment to a certain percentage by a certain year. But we're starting to explore importation of energy or power, green power, from neighboring countries, particularly Malaysia and Indonesia. Obviously, Malaysia had said no to us, so very much it's Indonesia. And looking further afield as far as Australia, there's obviously a group there who has said that they would be able to send power from Australia all the way to Singapore. Whether that's going to be economic or not, that's a separate issue, but we're sort of exploring that. So I think the the policies are still there in terms of trying to get to where we are. But I think the recent events, plus I think the Ukraine situation could see a change or a slowdown in terms of implementation of the overall policy. But I think the general direction is heading in trying to reach those targets to the extent we can. Obviously, certain industries like the data room guys are obviously wanting the supply of green energy, and Singapore, obviously a small island, we can't really self-generate any meaningful levels of green energy. So there's a bit of a need there's a need for importation, obviously, and other creative ways of trying to get green energy.
Ignatius, if I could ask, I mean, if these countries are really serious about renewable energy, don't they require an overhaul of the grid system that they're using? Some of them are using, if you go in the region, for example, some of the grid systems are just not compatible for renewable energy.
So here's the thing. So while there's I wouldn't say mad rush, but in some jurisdictions like Vietnam, I would categorize it as everyone's really rushing in. On the generation side, there's obviously grid constraints that has led to curtailment, particularly in the wind and solar projects. So a lot of the early investors that went in, fantastic feed-in tariffs like 9 over US cents, great, build it up, ready to go, and then EVN tells them, hang on, you can't export power because we've got a grid constraint in this area and that area, and there's no compensation, so they basically lose revenue, and so reality is hitting them hard. That's also a warning for new entrants coming to the market. So, it's a big issue, particularly in developing countries, and obviously Vietnam is trying to rectify it. They just passed a PPP law, which allows private sector participation in upgrading the grid. Hopefully that will, help alleviate the problem, but it's not a quick fix. It's got to be, it's probably 3, 5, 7, 10 years from now. So meanwhile, some of the early movers, are still suffering from curtailment, which is obviously not good news. From a Singapore perspective, I think we're looking at, easily 2 gigawatts of green energy, which apparently I was told the existing grid can take. But beyond that, obviously, you will require grid upgrades as well in terms of capacity to absorb the increasing production or generation within the grid or the imports coming in. So you're right. It's not only generation, transmission. The grid has to go hand in hand, and in many places, the grid, both in terms of capacity as well as quality, is lacking, and that will be the bottleneck for the years to come. Actually, when they may have hit their sort of generation targets, only to realize that it's not getting through. So that's going to be a very interesting issue as well. And financiers should be alive to that. If they miss that risk, then I think their money's at risk too.
I was thinking, Baldev, you obviously mentioned that this isn't all about energy, and there's a conversation to be had around other commodities, agri, metals, and so on. Obviously, we then immediately start talking about energy again. But I wondered if maybe we could go back to that. Are there any specific kind of legal issues you're seeing, or for example, maybe contractual issues, or it could be financing issues that are unique to, for example, agri or metals?
Not unique to the metals, but I think force majeure is a name you're going to hear quite often. And now with the Ukraine situation, every bloody day you're going to hear force majeure. And let's move aside from Ukraine for a second. So Indonesia, for example, they had requirements on domestic use of coal. So that meant that exporters couldn't export all the coal that they wanted. Same with palm oil as well. Whenever there's a scarcity around any sort of commodity, they wanted these countries that produce these resources want to direct it or want to ensure that their local population have sufficient amounts of it. Does that amount to force majeure? No, it doesn't. I think it's quite clear. But does it prevent someone from trying? No, everyone still tries it on and tries to raise the force majeure issue. The point about Ukraine is quite specific, and I think the one guiding value I can pass to the audience is this: is that everyone comes to us, in desperation or pleading or searching force majeure. And it's only force majeure if your particular obligation is affected, i.e., for example, in the event Russia is sanctioned for gas from a particular gas field, then yes, I think then if your contract obligation is to buy Russian gas from that gas field, you can be sanctioned. Sorry, not sanctioned. You can probably rely on force majeure. But if you're further down the stream and your job is just to buy any form of gas, then no, just because the Russian situation has caused a supply constraint doesn't mean that you rely on force majeure. It's a bit like saying there's been a La Nina effect in South America for the coffee plants or sugar plantations, and because of that, someone that's produced an end coffee packet or someone that's producing a finished substance that has got sugar in it, he claims force majeure. It just doesn't add up. Your force majeure must be directly related to the event that you claim that you prevented from. Because ultimately, if one country is affected or one jurisdiction is affected, then as a participant, you're more likely to be asked to go to another country to get substitute raw material.
And what we've also seen, particularly in the LNG side of the business, was firstly the COVID-related claims. Some of those, in some ways, were opportunistic. Back at the start of COVID, term prices were much higher than spot, and so buyers were trying to get out of term so they could buy spot. And now, if you're a seller and you've got to pay cover cost LDs if you don't deliver your cargo and you're in short of supply, you're looking at however you can use your contract to get out of those cover cost damages. So force majeure, COVID, and anything you can claim. So we are seeing people look at their contracts far more actively over the last 2 years. And also we're seeing people working the contractual mechanisms. How do you agree your annual delivery program, your 90-day schedule? What cargoes can you move from sort of a winter period to a summer period, or vice versa, depending whether you're buyer or seller? What rights do you have to UQT, and how firm are they? And often these parts of the agreement were drafted in a somewhat grey manner, as to reflect the negotiations that both sides wanted firm rights and they couldn't agree exactly on what the firm rights were. So they've got sort of grey rights as to whether they can or can't exercise certain obligations and rights. And that becomes quite interesting, seeing how the balance lies. But the difference between a spot cargo and a term cargo at the moment could be about $50 million. So there's huge amounts of money at stake, which is dragging the lawyers into the equation and what used to be a sort of a tradable commodity dealt with between the traders. So yes, interesting times.
Excellent, thank you. We've got a couple of questions in from the audience, so I'll take those in order. So first of all, I suspect, Ignatius, this might be one for you, but anyone feel free to jump in. What are the new initiatives in electricity storage? Ignatius, did you want to jump in? Are you seeing investment in or progress around electricity and storage?
Certainly. So I think obviously that's one of the sort of solutions in terms of trying to or getting the sort of renewables moving a little bit more mainstream, a little bit more into sort of the base load side of things. So there is a lot of innovation, a lot of investment trying to get that, the storage right, the ability to have longer and more reliable storage and so forth. So certainly, I think you see that across the globe. Actually, there's a lot of technology that's being explored, and some some work, whether it's batteries, particularly with respect to batteries and storage technology, essentially. So the short answer is yes, certainly.
And then presumably that goes full circle right back to what Balder said at the beginning around demand for those materials that go into batteries. So presumably there's further pressure on supply there if that kind of demand keeps rising. And another question, just I'm aware we're a little short of time. What will the green upgrading with different deadlines in different countries, what will that do to the competitiveness of domestic non-ferrous smelters or steel mills, for example? Does anyone want to take that?
Sorry, John, I'll take it, but can you repeat the question again?
Sorry, yeah, of course. So you have different deadlines in different countries for upgrading towards green or renewable energy. How will that affect competitiveness of domestic production facilities, so smelters or steel mills, for example?
That's a good question. I think I'll try to take it. So all the different actors have got to move towards these targets that they've set themselves for. Smelters in particular, I think, are in a tricky position. They are kind of beholden to the conventional energy system. So if you are a smelter, you are in a tricky position in the sense that you're meant to produce an end product that might be nickel or let's say nickel, and nickel goes into green initiatives. But yet to produce that nickel, you need to have high amounts of conventional energy. So I think to answer the question, I know it's not the best answer in the world, but I suspect it's going to be an unhappy compromise. I think they'll have to aspire towards reducing their targets or hitting their targets, but yet they're not going to get there because I don't think there's any other solution for them.
I think there's sort of two other things to add there. One is you're talking about the energy demand for smelters in the Western market. They are already under pressure for being high cost anyway. And so if they get the added burden of having to pay extra for energy, they will say, well, look, we can't operate. At which point politics steps in and realizes that the demand is greater than they can actually meet. And they want to keep domestic steel mills, etc., going. And so there'll be a solution to that side. The other side, and this is fairly local, you've got places like Sarawak and Sarawak Energy and their SCORE project, where they're building massive hydro dams and supplying electricity specifically for smelting projects. And they've got several there. At the moment, they're in negotiations with Indonesia and PLN to build another hydro system over on the Indonesian side of the border, and again, targeting the Indonesian smelting market. So what I think you'll see is in some areas is the smelting moving towards where the green electricity can exist. You might, one of the big things about Australia, you could cover sort of 10% of Western Australia in solar panels, and it's probably one of the best places in the world for it, and it wouldn't impact on many people at all because it's just so huge. Yet that could provide the electricity for a huge smelting industry. So I think we'll start to see smelters moving to where the green electricity can be to try and meet these targets.
Excellent, thanks. We're really tight on time. I think we've probably got time for one more question. Merrick, I suspect this is probably one to stay with you on. The question is, are we getting an LNG standardized contract that's scalable like EFET agreements in Europe?
I wish. We spend a lot of time working with people on their master sale and purchase agreements. And then helping them when they get up to speed using them the first couple of times until they get the hang of them. It is something that it limits the amount of trading in the LNG industry to some degree, because you have to go through this quite lengthy two-step process. They are slowly inching towards sort of more standardized terms. We're starting to see sort of BP and Shell, the big traders, their terms are reasonable and people are starting to accept them. But I do think it would help the industry a lot if there was a standard term for FOB and a standard term for DES or DAT, and that everybody could sign up to, and then all you have to do is worry about sort of delivery dates, volume and price. So I do think that would help a lot. But at the moment, you know, the big players all like their own form and don't want to work off anybody else's form. And there's a certain inertia there. And until sort of Shell, BP, Chevron, Exxon, Total all agree that, yes, we'll use this form, I think we'll be sticking with the variety of forms that we have at the moment. But it does make trading a lot more complicated because they're not the same, and you do have to check that what you're signing up to is actually what you think you're signing up to, because the subtle differences in some of these terms can have big effects when things go wrong, particularly when you're looking at whether your liabilities are capped or not when it comes to failing to deliver a cargo or failing to take one. And I think some people have uncapped liabilities, which they're realizing is a fairly major burden at the moment.
Excellent, thanks. Before we wrap up, anything Baldev or Ignatius you'd like to pick up on there? Excellent. All right. Well, we're out of time, so thanks so much to all three of you for speaking so kind of candidly and openly and insightfully on this topic. And of course, thanks everyone for your questions and for listening. Obviously, feel free to pick up with our speakers any other issues you'd like to talk about. But otherwise, yeah, enjoy the rest of your day or evening, and see you next time. Thank you very much.
Thank you.
Thank you.